Okay, thank you for coming into this live Investing Matters panel session with me. I hope everybody looking announced earlier to see the prestigious ball, magnificent ball that I've got as guests on my panel today. And what we have is a discussion today on investing in uncertain times. Why? Because we are in very uncertain times. So, who am I? I'm Peter Higgins. I'm the host of the Investing Matters podcast, which is part of the London South East brand, and they commissioned me to put together a library of investing content to educate born investors in core strategy and all experiences. And what I've been doing is interviewing fund managers, economists and analysts and journalists online to share their investing journeys. And I'm blessed today to have with me Moira O'Neill. Moira, award-winning freelance investment specialist and currently a columnist with the financial client with a vast array of experience. And I've got Jay Younger, a little way back to Jay, investment analyst at Aubrey Capital. And I've got the smiley face assassin, which is the award-winning journalist and author and investor editor at Citywire. In lead companies, Algy Hall. And I have also got Iain Barnes, Chief Investment Officer at Netwealth, and they're all going to do a 4-minute talk for you today on strategies to navigate uncertain times. So I'm going to share this quote with you from the father of efficient markets, and that person is Peter Bernstein. And Peter's quote is, "The fundamental laws of investing is the uncertainty of the future." And with that note, I'm going to start with Moira.
So I'm going to defer on the investment stuff to my esteemed colleagues over here, but I'm going to focus on the practical stuff that you can do as an investor to feel more in control when things are feeling uncertain. And the first thing I do is I look at a long-term graph of the stock market because that gives me confidence. It makes me feel like, along the way there have been these horrible blips in the road. We're seeing more awful things happening. The stock market's done a dip and then it's come on to rise up. And I think you can show that to anyone who's interested in starting investing to give them a bit of confidence too. And of course, we always have to say it's not necessarily going to pan out that way. But for me, that gives me confidence. And then I think you do have to acknowledge that a lot of things are out of your control. Markets are out of our control. Politics are out of our control. But the thing which is on our side is time. So there are not that many 10-year periods in the stock market where things have gone completely pear-shaped with investors, so if we were Scott, we're not going to have one. But I think you could also do lots of things that are in your control to make your financial position better. And one is to keep your costs low. I bang the drum about this a lot. So whatever platform you're using, has that got the right charging structures for you? Could you move your investments elsewhere to get a better deal? You can consolidate your pensions to get your costs low as well. The Hotspurs have old pensions that were from our earlier careers that might be a few thousand or so. Put them together in one, get a good deal for your pension management. And then using our tax relief. I hope you all are in this room. You're probably using your biases, etc. But so many people don't do it, or they put it off, or they have things in a general investment account and they don't move it in. And of course, capital gains allowances, dividend allowances are about, they'll be slashed and slashed again next year. It becomes really, really important to have your investments in an environment where they are growing free of tax. I get as much pension tax filling as it could be. Really important to give your pensions a boost, get that income tax relief as well. And then on the whole investment decision-making fronts, because when things are feeling really uncertain, that can make you feel emotional. I have to acknowledge that we are emotional beings. We can rush into decisions, we can put them off just for the fear of getting it wrong. And it's really important when you're feeling that way to carry on making decisions, but to make them in a rational way. So if you can write down why you're making the decision, why are you putting each an ISA, why are you buying this share, why are you buying this fund, etc. And just write it down for your own comfort. That's a really great way to master a bit of control. You don't have to rush into things. You can put your money into tax wrappers such as ISAs and just keep it in cash. Park it in cash for a while you make the decision. And the other thing, which is a brilliant discipline, is drip feeding your money. So paying yourself first, drip feeding it on a monthly basis, and making sure that you carry on investing through thick and thin, because when the markets are going like this, you can keep on buying. You can put yourself at an advantage by automatically buying on the dips and buying less when the market goes up as well. When you look at your portfolio, I'm not a portfolio strategist, but there are some basic things that I do of my own that I probably do once a year, and that is to just check how risky it is, how it performs, check the mix of asset classes. Have I got enough equities? Have I got bonds, commercial property, gold exposure, some other things that hopefully will perform differently to the equities in there? And then, is it spread geographically? So am I lowering my political risk by spreading my investments around the world? And then also, do I have different sectors in there, different industries, etc.? And infrastructure, food, things in certain times that keep delivering are always good solid things to have in there. And the other thing is to make sure they have different company sizes, so mixtures of the big players and the smaller players and the medium players. I think it's just to give yourself a sense check every year. And then the other thing which when I worked with Algy at the Investors Chronicle, I used to look at reader portfolios and analyse those, and we always saw people collecting investments at great length. So there was always a mixed bag in there of all things that maybe looked a good idea 10 years ago. Do you really want to be holding it today? Do a spring clean, check that if you would buy it today, and how that's in your mind. And if there's anything that is there which is a tiny minuscule bit of your portfolio, you can just ditch it. And so it's under 1%, it's not contributing much to the overall return. Consider reducing it and tidying up, having less to think about. So that's where you get the controls act. And I'd also always, when you're looking at your investments, consider your whole financial picture. So are the assets that you can fall back on in a worst case scenario, because that gives you comfort as well. And think of other people, if you're in retirement or nearing retirement, the asset that most of us hopefully have was the home. There's always something to fall back on there. Could you downsize? Have you had a conversation with your children that they would encourage that or not, etc. And then something which I've written about quite recently in the Financial Times is to use a free cash flow planner to look at how your investments could pan out under different scenarios. And then it gives you an idea of the range. And there's some great tools out there. I'm going to give Netwealth the plug, which is for our colleague. But there are some others which are called Financial Mentor or Guide, which you can put your pensions investments into the planner, and you can say what growth rate you're thinking and guess or what inflation rate there's going to be, and seeing how it pans out for your lifetime and income money is going to last for you. And I would use one of those at least once a year. So by doing all of these things that give you back some control, I think can feel less uncertain. I hope that's been helping. Thank you. That's very much.
We have two younger from Aubrey Capital to share with you with a strategy regarding investing. When investing in the sides, it can be quite tempting to cheap one's investment strategy. So, for example, we've seen Russia hitting Ukraine, we see interest rates rising and inflation pumping. And during 2022 as a growth investor, it might be quite tempting to allocate capital to those sectors which are predominantly characterised by, say, lower PE multiples, because those sectors were typically outperforming, such as energy, dominated by oil and gas companies, financials, dominated by banks,
Whereas as a growth investor, you're probably in sectors which are characterized by quite high PE multiples, so things like information technology and consumer discretionary stocks. And it was quite disheartening to see that despite these companies having earnings per share growth much greater than the market, or even greater than those sectors which were outperforming, they experienced the most derating. So why would you not change your investment strategy and allocate capital to those outperforming sectors such as oil and gas and financials? Well, the answer is a proven track record. I've only been in the industry for 6 years. Mine was a 2-month sabbatical last year where I got lost in Mallorca. But over my 6 years in the industry, I've seen how a strategy which is dedicated to growth investment outperform. And I think part of that investment process, Aubrey Capital Management, is investing in companies which can grow their earnings at 15% per annum year on year, and investing in companies which have a capital return on assets of 15% per annum, what we call the self-financed organic growth rate. And the reason why we choose 15% is if you look at the historical equity market returns over each year, they typically generate about 5% real rate of return. You then need to add an adjustment factor onto this for inflation, so call it 4 or 5%. So that gives you a nominal rate of return around about -10%. You then need to take into account the fact that as active managers, we need to justify our existence. So we need to outperform the market by typically 2 or 3% each year. So that takes you to a rate of return of around about 10 or 11%. You then need to take into account that not all our decisions are correct, and some things we get them wrong. So if we make the assumption that we get around about 70% of our decisions correct, you divide 10 or 11% by 70%, you get de facto 15%. And the key point of this 50% is that takes into account all the variables that we just spoke about there, the assumptions for getting wrong, inflation, and the historical equity market performance. And the long term from these Aubrey is that the company that you invest in, its external share price performance will only mirror that of its capital return on assets. It will be no greater than that for the long term. So therefore, it's really important when you're constructing portfolios to construct it with companies which have a high capital return on assets as possible, also known as the wealth creation of these companies. And, I mean, at Aubrey, we know the claim to be perfect market timers, and I think, in fact, many few people are. So if you go back to that assumption of 70%, getting your decision right 70% of the time, it is perfectly market time. The first chance, you got 70%. The second chance, you got 70% of that 70%, which is a probability of 49%. And then to get the third decision right of the 70%, that's a probability of 34%. But by contrast, invest in companies which can achieve at least a 50% per annum earnings per share growth, along with a 50% cash flow return on assets, along with this Asian discipline, regardless of market timing, you should outperform in the long term. So that's all I'm going to say about investing in certain times.
Thank you very much, Tim.
Hello. So I thought, Peter, that was a great quote you started with, the quote about uncertainty. It was we're talking about uncertain times, but one constant in investing is uncertainty. You never know what's going to happen around the corner. Often the risks that we see in the market at one time, they stay there for years and years, and then suddenly they spring out and hit you. So uncertainty is always there. But I think when we talk about uncertain times, what we actually mean is stressful times. And normally people feel they've gone uncertain when, we've lost some money and we're wondering when we're going to lose more money, and it's a horrible feeling. But it also is incredibly interesting psychologically, because as humans, and which is common with other animals, when we're under stress, we actually change the way we view the world around us. Our time horizons shorten significantly. So rather than thinking about the chart which Moira is talking about, the long-term kind of charts of investments compounding and us becoming rich, we think about tomorrow as a fact that the market's open and we may lose a significant amount of money, and feel like that at the time. It's visceral, and we just we want to deal with the pain. And when we're under those kind of pressures, we can make really silly decisions quite often. Sometimes it's like it's not always the fact that we don't need to make decisions, so we do.
But if we haven't got a plan, we can really, we can go wrong. We don't know why we're doing what we're doing, and we can do the wrong things. Also, these times of stress, one of the really interesting things is that we feel a need to latch on to narratives. We feel like we want stories which are going to explain everything to us, which is, it's almost the opposite of uncertainty. Uncertainty is the fact that we just don't know a lot of things. We can't predict a lot of things. We'll look at history and we'll see the stories which have played out over history, and lots of things we're very certain the reality inherent, but we fail to be able to appreciate that actually during that time the outcomes weren't certain. They could have been very different had things played out differently. So we look for explanations which don't exist. And that can also make us do dangerous things. So anyway, what is all this getting into? Well, what I think is, the most important thing to understand about uncertain times is that ahead of entering a moment of stress in markets, you need to have your plan sorted out already. You need to really think about, what am I going to do? I know as an investor, when I look at these long-term graphs, they're all in jumps down. And, if you've been through one, you know what they feel like. They feel ghastly. They feel like, the world's ending, the whole financial system's falling apart, whatever it is. Even if you know it's not rational, you feel it. So you need to plan ahead of time what you're going to do in those circumstances. Do you just do nothing? You have to be absolutely fine. Do you just rebalance? Or, do you think you have some kind of advantage which means you're going to be able to trade it? I mean, I'm not a believer in market timing, and I think very few people actually are, because the record isn't even that great. But, if you do believe you've got that, know exactly why you think you've got that, know what you think your advantage is. And echoing something that Moira said, the best way you can put that plan in place is write it down. Write it. I'm a journalist, so you'd expect me to say something like about writing, but writing is incredibly powerful, just in terms of getting your thoughts in order. If you actually have to put them on paper, there's no better way to check that they've made sense. And then also, if you want to make them usable in the future, to get them as succinct as possible, to give them down, bullet points, a few clear rules to yourself when you won't be thinking straight because you'll be under stress. It's invaluable. And also just to extend that idea of planning. The most important plan is knowing what your objectives are and knowing what you're going to do during uncertain times, during times of stress. But you can also extend this idea of writing an investment journal for all your individual investments. So you actually know ahead of time what you think is going to happen, so you can judge whether that happens or not. And also what you think may go wrong. What you're already alerted to the fact that, this isn't working out how I thought it would. And, it is not what I thought it would be. So actually, time out. I'm going to sell this and try and move on to something else. But I think that's really, without going into the myriad of ways you can create your journal, just to actually try and start having a written plan and also do it for your individual investments. It'll make everyone in this room, if you're not doing it already, a better investor, and it'll happen quickly, and it'll be amazing if you start to do it. I can recommend anything more. Anyway, that's it.
Hello everyone, thank you very much for your time. I'm going to just talk a little bit about how we see the world and the important things about
Managing money and social finance.
And you're going to touch on a few of the points I think were raised by colleagues here. And the first one is really about discipline, and something that really resonated for me from all of the three different speakers as important points to make. Keeping the stuff in something to happy with. So at Netwealth, we were launched in 2016 by a group of people who had different careers around various institutions in the city, and trying to take the best parts was traditional wealth manager and wrap it into a more technologically enabled sort of framework. And by that way, sort of taking the best of both worlds, if you like. And when I think about the important things that are keeping in mind when managing money into uncertainty, there are two aspects I'd like to focus on. First one is our investment approach. So as the leader of our investment strategy, it's our responsibility of building diversified, robust investment portfolios that can manage a range of different market and economic environments, and we certainly see quite a few of those recently. The second is make sure there's a little bit of flexibility, and again, something Ali touched on is that within your framework, making sure that you're able to shift things a little bit as and when you need. The most important part, however, that we always focus on is efficiency. So we have a centralised investment proposition. So everyone's money is looked after by the same investment team, and importantly, we maintain efficiency across the range of portfolios. So we invest predominantly in exchange traded funds, ETFs, because we feel it gives us focused exposure to the areas we want to target, but also doing so at low cost. And that low cost component is really, really important because it gives a huge tailwind to the performance that clients can see. So we get a compounding effect, the fees are low and more returns get built up through time. The second part, however, that we think is important when looking at uncertainty is the wider approach. Now, Netwealth is what we call a hybrid company, so it's taking high quality tech. Half of my colleagues are developers or engineers, and by offering a strong tech framework, you're able to make sure that you can understand and interrogate your investment strategy as you see fit. And that level of transparency and clarity is something that we felt is always needed, and something that's sadly quite lacking across a lot of the industry. The other part, however, is the hybrid is the marriage with qualified investment professionals. So financial planning, enabling people to check in on the way that they're set up to deliver on their investment objectives is key. So having access to those people as and when you need it is vitally important when things change. We decided, however, to take things a little bit further, and I was delighted Moira mentioned it, with the launch of a service called Netwealth, which is basically a wealth tracking and forward planning tool that's available to make sure that all of your investments, wherever they might be, are on track. So you don't have to rely on spreadsheets that you've put together. Now it's a consolidator, so you can take ISAs that are in one place, or action being managed by someone else, or a lot of you may be DIY investors, have stocks and shares that you like in various different platforms. Put them all in one place so you can see how things are going and keep an eye on things as needed. But the key part is that it's free. You don't have to be a Netwealth client to be able to use it, so I'd love everyone to log on, have play around, and just be able to keep an eye on everything. The next component is that for users of Netwealth, we offer a sort of financial planning MOT, so a low-cost check-in that you can do periodically with one of our qualified advisors, just to make sure that your own plans are on track and you're happy with all of those different moving parts that are available. So from our point of view, I'd say the two things that are the most important is making sure that you've got access to diversified investment exposure. You're not subject to the market changing its mind on what's attractive or not at any given point in time, so that you don't have too many surprises. And secondly, have some sort of framework in place whereby you can check in either on your own or with someone who is able to offer advice, whether that's formal advice on an ongoing basis or just a quick check-in to make sure that everything's on track, and just so you've got an eye on everything as it should be. Thank you.